Credit cards look simple on the surface. Swipe, tap, earn points, pay later. That is the story most people believe. But hidden beneath that smooth plastic is a quiet system designed to drain money slowly, patiently, and legally. Credit cards promise freedom and convenience, yet millions of people feel more trapped every year. The shocking truth is that the real cost of owning a credit card is rarely visible on the statement, and by the time most people notice it, the damage is already done. Welcome to Meta Economy Lab, where you can learn and understand more about the economy and related topics, so you can subscribe to the channel for continuous learning. The idea of borrowing money is not new. Long before plastic cards existed, merchants extended credit through handwritten ledgers. But everything changed in the mid-20th century when banks realized something powerful. If borrowing could be made effortless, spending would rise. And if spending rose, profits would follow. The first modern credit cards were marketed not as debt tools, but as lifestyle upgrades. They were symbols of trust, success, and convenience, carefully designed to feel harmless. In the early days, credit cards were simple. You borrowed, you paid, and the relationship ended there. But as competition grew, banks began experimenting with interest, fees, and penalties. These were not accidents. They were carefully tested systems meant to extract value from human behavior. Miss a payment by one day, and suddenly your balance grows. Carry a balance for a month, and interest compounds silently. Over time, these small costs became massive revenue streams. One uncomfortable truth is that banks do not make the most money from customers who pay on time. They make the most money from people who almost pay on time. Those who are responsible enough to keep using the card, but imperfect enough to carry a balance. This group represents billions in annual profit. The system is not broken. It is working exactly as designed. Consider interest rates. Many people glance at the APR number and move on. But an interest rate on a credit card is not like a loan from a friend. It compounds daily. That means every single day you carry a balance. Interest grows on top of interest. A small purchase can quietly double in cost over time without ever triggering an alarm. Then there are fees. Annual fees, late fees, foreign transaction fees, balance transfer fees, cash advance fees. Each one looks manageable alone. Together, they create a steady leak in your finances. Many cardholders do not even notice them until months later. By then, the money is gone, and the habit continues. Rewards programs make this even more complicated. Points, miles, cashback, and perks are marketed as free money, but rewards are rarely free. Studies show people spend more when using credit cards than cash. The psychological distance between you and your money disappears. Banks understand this, and rewards are the bait that keeps spending high while interest quietly grows. There is also the cost of minimum payments. Paying the minimum feels responsible, but it is one of the most expensive choices you can make. Minimum payments are designed to stretch debt over years. A balance that could be paid off in months can last decades, generating interest the entire time. This is not explained clearly, and most people learn it too late. Behind the scenes, credit card companies rely heavily on data. Every swipe tells a story. Where you shop, when you shop, what triggers spending. This data allows banks to predict behavior with scary accuracy. They know when you are likely to overspend, miss a payment, or accept a higher limit, and they adjust offers accordingly. One rarely discussed cost is stress. Financial anxiety affects sleep, health, and relationships. Carrying credit card debt keeps the brain in a constant state of alert. Even when life looks normal on the outside, debt quietly shapes decisions, limits options, and narrows freedom. This emotional cost never appears on a statement, but it is very real. Another hidden cost is opportunity loss. Money spent on interest cannot be invested, saved, or used to build security. Over a lifetime, interest payments can equal the cost of a home, education, or retirement savings. This silent trade-off happens slowly, making it easy to ignore until it becomes impossible to reverse. Credit limits also play a psychological trick. A higher limit feels like progress, but it is not income. It is borrowed money with conditions. Many people mistake access for wealth, and that illusion fuels deeper debt. Banks increase limits not to help, but to increase potential interest earnings. Even paying on time does not guarantee safety. Promotional rates expire. Interest jumps without warning. Terms change quietly. A card that once felt manageable can suddenly become expensive overnight. The rules are written to protect lenders, not borrowers. Historically, attempts to regulate credit card practices have faced heavy resistance. Lobbying ensures flexibility for issuers and complexity for consumers. Disclosures exist, but they are dense, technical, and easy to ignore. Transparency exists in theory, not in practice. Real stories reveal the truth. A teacher using a credit card for emergencies slowly accumulates interest until monthly payments barely reduce the balance. A young professional chasing rewards ends up paying more in fees than the rewards are worth. These stories repeat across generations. The system thrives on normalization. Everyone has a credit card, so it feels safe. Debt becomes background noise, but normalization does not mean harmless. It means invisible, and invisible costs are the most dangerous ones. Technology has made credit easier than ever. One-click purchases, mobile wallets, and automatic billing remove friction completely. Convenience increases usage, and usage increases profit. The faster money moves, the less time we have to think. Even credit scores play a role. Fear of damaging a score keeps people tied to cards they should close. The system rewards ongoing participation, not freedom. Credit becomes a necessity instead of a tool. As inflation rises and wages struggle to keep up, credit cards fill the gap. They become survival tools instead of conveniences. This shift increases dependency and deepens long-term costs. The more people rely on cards, the harder it becomes to escape them. Banks publicly promote financial literacy while privately benefiting from confusion. This contradiction sits at the heart of the system. Knowledge threatens profit. Simplicity threatens revenue. Complexity protects it. The real cost of owning a credit card is not just money. It is time, stress, missed opportunities, and quiet dependence. It is the slow erosion of control masked as convenience. Understanding this does not mean rejecting credit entirely. It means seeing it clearly. A credit card is a powerful tool, but only when controlled fully. Without awareness, it controls you. The first takeaway is that interest is not passive. It is aggressive, constant, and compounding. Ignoring it is expensive. The second takeaway is that rewards are psychological tools, not gifts. They influence behavior more than they help finances. The third takeaway is that convenience always comes with a cost, even when that cost is hidden. Looking ahead, credit will become even more embedded in daily life. Digital money, instant lending, and invisible payments will blur the line between spending and borrowing. The question is not whether credit cards will change, but whether consumers will understand them before the cost grows higher. If this video helped you see credit cards differently, take a moment to like it, share your experience in the comments, and subscribe so you can continue exploring how money systems really work. Meta Economy Lab gives you new perspective to see and understand more about the economy and related topics, so you can subscribe to the channel for continuous learning.